When you start to come back to the U.S. and you look at the 10-year, 2-year yield curve, we're negative. We were last negative back in 2007, 2008. And then obviously kind of in the late 80s, early 90s, as well as the 2000 tech bubble bursting. What is this telling you? Like, how much should we be worried about this given just how obvious it is that, this is happening?
Yeah, so I mean, really, the bond market isn't really buying the long-term inflationary outlook. You're seeing front end of the curve, the 2-year, it's spiking up because inflation pressures continue to intensify. But the long end of the curve, the 10-year, 30-year, they're actually starting to fall materially against the front end of the curve because of the long-term, basically the long-term reality of way too much debt and the demographic outlook, which are both kind of deflationary factors. When you see a huge inflationary impulse like we're seeing today, paradoxically, over the medium to long term, that's actually kind of it leads to deflationary outcomes. And so I think that's what the Fed's tightening policy is actually doing. It's setting up for somewhat of a spectacular deflationary bust, and the bond market is kind of smelling it out. So while you see earlier in the year in 2022, the treasury bond market had the worst start of its year in recorded history, right? As duration got killed because yields went up. So long dated bonds, long dated debt, even though you kind of can secure in that nominal yield over the course of the debt, mark to market wise, the bonds got killed in value. And so now you're starting to see the long end of the curve relative to the short end. Bond market is supposedly the smart money. They're not buying this long-term inflationary outlook. And you're seeing a lot of kind of commodities start to sniff that out as well.
When you then take a comparison like the CPI year over year versus the Fed funds rate, again, pretty concerning stuff here. What is this telling us?
Yeah, so we kind of talked about the structural issues and the debt to GDP a little bit earlier, right? So when we look at the kind of the Fed's messaging, the messaging from the Treasury, and just look at kind of the global debt bubble that we knew we had coming into this, and post-COVID, the reality that central banks were facing. The reason that they wanted inflation over yields in the first place was because debt to GDP was so elevated. So if we just skip over one slide to slide number 5 real quick, there's a pretty amazing stat, and I might get some of the details wrong, but of nations that have 130% debt to GDP over the last, I believe, 80 years, there's been 52 of them. Only Japan, which is now experiencing a mass currency devaluation, hasn't defaulted on its debt, either explicitly defaulting or kind of implicitly defaulting through a huge spurt of inflation, right? So the U.S. Debt to GDP actually in Q4 of 2020 hit 136%. Through high inflation and low interest rates, we actually got that that debt to GDP number, public debt to GDP, to 124%. All it took was just 8% CPI over the course of the year, but that was a playbook, and they actually executed it well. They got the real burden, the real value of that debt lower, but now because of that kind of political pushback, they have to reverse course. And so I think ultimately it's not going to last. It's just mathematically not a reality that can persist for long, given that as the economy slows, as asset values crash, you're going to see tax receipts absolutely plummet, and the federal government and the Treasury isn't going to be able to fund itself. Interest expense on this debt is going to be far too high with yields at 3% rather than, say, 1% or 1.5%. So we still have this debt spiral dynamic that a lot of people like Greg Foss talk about. It's just over the short to intermediate term, it's kind of unwinding, right? But ultimately, there is that reality that the Treasury, that the U.S. government has to fund itself. And so I think that's kind of where the long-term thesis of further debt monetization, money printer go burr, and the Fed kind of backstopping this entire credit system comes back into play. That long-term kind of dynamic is absolutely unchanged, despite all the craziness in the short term.